What's up everyone, Adrian here. Welcome to another video. In this video, I want to discuss my investing philosophy and strategy in detail. The reason why I decided to make this video now is because my highest viewed videos are my stock picks. So since we passed 1,000 subscribers and have thousands of views and thousands of watch hours, something I never thought I would achieve, I think it's only fair that I share my investing philosophy as it's the driving force behind my stock pick. So like the name of the channel says, I consider myself an income investor and I use the passive approach. This strategy has enabled my wife and I to become financially independent in our mid-30s. So how does this strategy work? How does it compare to the growth strategy? What are the benefits of my strategy? Well, I'm going to explain it to you right now. So being an income investor simply means you're trying to maximize your annual income. If you have a job like most people do, this is obviously what you're trying to do already. You go to work, you put in the time and effort, and you get a consistent paycheck, which is heavily taxed if you're Canadian like me, but nonetheless, you use this money to pay all your living expenses. So the same is true for income investing, guys, but instead of putting in your time and effort at a job you probably don't like to make money, you're investing your money to do all the work for you. So you're basically creating money out of thin air. So since the money is doing all the work for you, the income is called passive income since you're not putting any effort directly in generating this money. Sounds great, right? Almost like a dream come true. Well, that's because it is. So I achieved this with 5 key points. Let's check them out. Alright, so key point number 1 of my strategy, which I think is the most important one, I only invest in stocks and funds that provide income. The most common form, of course, are dividends. A dividend is simply a portion of a corporation's profit paid out to investors on a regular basis. So REITs or real estate investment trusts, ETFs, and other funds that pay out income is actually called a distribution, not a dividend, but it's basically the same thing. The only difference is that it's taxed differently. So I won't get into taxes in this video, but I'll probably make a video on that down the line since I get a lot of questions on taxes. So this is the most important key to my strategy, guys. My goal is to generate consistent income like a paycheck. So I would not invest in a stock that does not provide income. But one very important thing I want to stress here is that there are many great companies I invest in that don't provide a dividend, like Amazon, Google, and Tesla. So you can still invest in those companies indirectly by investing in a fund like an ETF that holds these companies. If the ETF pays out a consistent distribution, you're good. For example, I own an ETF that holds technology companies. Most of the companies in the fund like Google and Amazon don't pay out dividends, but the ETF does. So another thing to mention is that I am comfortable investing purely in stocks or equities. I don't buy that common notion to buy 50% stocks and 50% bonds. That's just nonsense if you ask me. Bonds suck in my opinion. Not only is the income they generate dismal compared to stocks, but the income they generate is not tax efficient because it's interest income. So interest income is taxed more heavily than dividends and capital gains. Also, if we're talking about government bonds, you're dependent on, well, the stability of the actual government issuing those bonds. So I don't know about you, but I trust big and well-established blue chip corporations over the government any day of the week because at least corporations provide goods and services we all need. So another important point I want to make is that my primary concern is not stock price appreciation or capital appreciation, it's generating consistent income. Growth investors, on the other hand, are not that concerned about how much income a stock is generating for them right now. They're more concerned about the potential of the stock price in the future. They are more dependent on that company or fund doing well, so the stock price goes up, so they can then sell shares to actually make a profit or their income down the line. Me, on the other hand, I'm not really concerned with the stock price. Yes, of course, I always do consider the stock price before I invest in something I'll discuss in my third key point, but my chief concern is always getting that consistent income now, not later. I use this income to pay off all my living expenses. I'm not putting in a bet to maybe become rich in the future. You get consistent cash flow right away, and that's the key. This is the fundamental advantage of the income strategy over the growth strategy. You're getting your money now instead of waiting for it later. This means that I'm a lot more indifferent to what the stock market is doing. I don't really care what the stock prices are doing as long as it keeps paying me income. This in itself is another great advantage of the income strategy because you're much less stressed out about what the stock market is doing. And as you know, it could be a roller coaster sometimes. Alright, key point number 2 is I use a passive approach or a buy and hold approach. So using a buy and hold approach is exactly what it says it is. You invest in a stock or a fund or whatever and you hold it forever. You never sell the shares. This is why when I invest whatever sum of money it is, I always say to myself, okay, that money is now gone in a sense. It's spent. Because like one of my financial idols always says, Kevin O'Leary, never touch the principal, only spend the interest. So active investors consistently buy and sell stocks in order to make a profit or a loss. So when I first started investing back in 2012, I was actually an active investor. I would hunt down stocks I thought were cheap, just using my gut instinct, and then wait until they rose to a certain level I was comfortable with and sold them to make a profit. This is also called swing trading, and trust me, although I made more money than I lost using that strategy, it's a very hard strategy to pull off. Not only is it very time consuming, but you need to have the skills to analyze businesses or analyze stocks, which 99% of the population doesn't have. We don't have the skills or the time. Only the very best can pull off this strategy, and sometimes they don't get it right. Also, it's very stressful, guys. You're constantly watching every day the stock prices. Should I sell now? Should I wait a bit more? The stock just tanked. What do I do? Do I cut my losses and run? Do I wait it out? Trust me, I just get anxious thinking about it now. If you're an everyday working Canadian like myself, it's much easier to adopt the buy and hold passive approach. I'm not saying it's wrong to be a trader, guys. I'm just saying it's more stressful, and most of us are definitely not qualified to adopt this approach. Alright, key point number 3, I'm a value investor. So you can still be a value investor even if you're using the passive approach. Being a value investor simply means you're on the lookout for stocks or sectors of the market that are undervalued. Remember, dividends and distributions tend to remain very stable. So this means that if a stock price of a fund or a stock is low compared to its 1-year high, for example, it means that the dividend or distribution that they provide is higher now. So think of it like a Boxing Day sale. It's the same TV, but now it's $800 instead of $1,200. It's on sale. Well, the same applies to stocks. Stocks are basically businesses or a fund that holds a collection of businesses. So business won't always be great, guys. They have their ups and downs like everything else. But like I mentioned earlier, the income or the dividends they provide usually remains pretty stable. So if the stock price goes down 20% within 1 week, for example, and you decide to invest at that time, it means the income you get or that the stock will generate for you is 20% higher than if you had invested in the same exact company or fund 1 week ago. So it's actually very easy to find a value. You can simply look at it in terms of sector, and you don't have to be an expert in any way, shape, or form. The stock market has 11 sectors. Which ones have good value right now, for example? Well, that would be the financials, the real estate, and the energy sectors. The COVID-19 pandemic has hit these sectors really hard for various reasons, while the gold and technology sectors have done the opposite. They've done great. So if you're a value investor, you would be prioritizing undervalued sectors right now and not touching the tech and gold stocks simply because that's where the value is right now. Nobody can control or predict the market, guys. Don't forget that. Outside forces out of our control, like COVID-19, will always come up in our crazy world. So there will always be sectors on sale and sectors that are more expensive. Using a value approach is a pretty easy way to maximize your income in a way, because you're getting, well, more value. So my stock picks are heavily based on value. You always want to get the most bang for your buck. It's really not rocket science. Alright guys, key point number 4 is income safety and consistency. So safety can mean a lot of different things for different investors, but for me personally, the safety of the dividend or the distribution, basically the income, is the most important thing. Like I mentioned before, the stock price, not so important for me. If it goes up, if it goes down, I'm pretty indifferent, because I buy and hold stocks without the intention of selling them later on. So why would I care that much about the stock price? That is why the majority of my portfolio is not in individual stocks or individual businesses. The COVID-19 market crash back in March taught me a huge lesson. The most at-risk stocks to reduce or even suspend their dividend, which is basically the worst case scenario for an income investor like me, are individual businesses or individual stocks, especially the smaller companies. Now, I'm not saying it's bad or wrong to invest in smaller or individual companies. They can actually give you fantastic returns. All I'm saying is that in terms of consistent and safe income, they're not the best choice. So to achieve more safety, I have been gravitating more and more towards funds like covered call ETFs, which you know I'm a huge fan of if you watched my other videos. So these ETFs, for example, are specifically designed to provide investors with consistent income. They're designed in a way so that the income they generate has very little to do with the stock price. This is just one example. You also have REITs or real estate investment trusts or some closed-end funds. So anything designed to provide consistent income has my focus and attention. So the safety, just to recap, the safety of the income is the most important thing to me. The consistency of the income, not the stock price or the capital appreciation prospect in the future. Alright, so the fifth and final point, which also ties into safety, is diversification. So diversification is very important for a passive income investor like myself, because I'm not actively managing my portfolio. I'm not picking and choosing stocks in order to sell them later. First of all, I don't have the time, like I said, or the knowledge to do that. So having a piece of all the sectors, knowing that the market has its cycles, is very key. It's very important. I know some sectors will do well sometimes and some sectors will be in the dumps sometimes. So by being diversified, you always ensure you get a piece of everything. So I won't pretend I have a perfect balance of every single stock market sector. I tend to focus on the market sectors that are more stable in terms of generating consistent cash flow. The utilities and communication services, for example, I absolutely love these two sectors. COVID-19 or not, everyone needs their electricity, right? You always need your voice and data or your internet and phone service. Financials is another one. Banks, insurance companies, wealth managers. The financial sector of the stock market is probably one of the most lucrative in terms of dividends, because we live in a capitalistic society that heavily relies on these institutions, some of which are older than my great-grandparents. So then you also have real estate. That's another example. Everyone needs shelter, right? So focusing on the more stable sectors in terms of cash flow generation can be beneficial. It's very important to try to get a piece of everything. So that is what we call sector diversification, but keep in mind, geographic diversification is equally as important. So I'm Canadian and I'm definitely more familiar with Canadian companies and I trust them, but I would be an absolute fool if I only invested in Canadian companies. What if some disaster strikes Canada? Who knows? So that's why I think it's important to be diversified in terms of region as well. You need some US exposure, European exposure, some emerging market exposure can't hurt also, although they're a bit more unpredictable because their economies are not as advanced as first world nations like Canada and the US. At the very least, guys, you need to have several developed economies: Canada, US in North America, the UK, France, Switzerland, Germany. Those are the 4 biggest economies in Europe. I also like to have some exposure in Japan and Australia on the Pacific side. So the more diverse you are in terms of region, the more balanced your portfolio will be. So combine sector diversification with region diversification and you're basically set. Day traders, swing traders, and famous portfolio managers, guys like Warren Buffett or Bill Ackman, don't care about diversification. Warren Buffett actually said, and I quote, "Diversification makes very little sense for those who know what they're doing," end quote. So why would he say something like that? Well, that's because guys like him and other stock pickers only care about picking and choosing businesses they think will succeed and do well in the future. They don't care what sector they're from or what region they're based in. He went on to say, and this is very interesting, quote, "Diversification is a protection against ignorance. If you want to make sure nothing bad happens to you relative to the market, you own everything. There is nothing wrong with that. It's a perfectly sound approach for somebody who does not know how to analyze businesses," end quote. I don't know how to analyze businesses. Do you? Exactly. He basically just proved my point. So diversification, very important. So those are the 5 key points to my investing philosophy and strategy. If you learned something from this video or just enjoyed watching me babble on, please hit that like button. They say it all helps with the YouTube algorithm, whatever that is. So I just hope it helped you understand what I feel passive income investing is all about. So if you're a new investor and like my investing philosophy and want to build your own stream of passive income, make sure you subscribe to my channel and turn on notifications, because I do a lot of stock pick videos, so you don't want to miss them. My goal in creating this channel remains the same: helping everyday working Canadians to invest on their own in order to build a stream of passive income so they can enhance their quality of life and eventually reach the ultimate goal of financial freedom. So with that, take care everyone, stay safe, and see you next time.